The market is closed, and Opendoor Technologies Inc. Open finished the last trading session on Friday, September 12, 2025, at a closing price of $9.07, representing a significant downturn of negative 13.78% on the day. This isn't just a daily blip. This is a dramatic reversal of the explosive momentum the stock has seen in recent weeks. The common expectation, fueled by the recent leadership announcements and capital infusion, was that the stock was on a clear path to recovery, leaving its speculative past behind. However, the reality of Friday's brutal session tells a different, more complex story. The dramatic swing is a stark reminder of the volatility inherent in this name, and it forces a complete reevaluation of the bullish narrative that has captivated so many investors. The question is no longer how high can it go, but how fragile is this rally, and what does this steep drop truly signify? For weeks, Opendoor was the darling of the retail investment community. A frenzy of positive headlines had been cascading across the financial media, igniting a powerful short squeeze and bringing the stock from penny stock territory to its recent high. The catalyst was a bold, unexpected shakeup at the very top: the return of co-founder Keith Rabois as chairman, the re-engagement of co-founder Eric Wu with the board, and the appointment of a new CEO, Kaz Nejatian, a former Shopify executive. This was the masterstroke, a narrative shift from a beleaguered iBuying model to a tech-forward, founder-led enterprise. The narrative was simple and compelling. The Open Army, as some on social media have dubbed it, was back in force, armed with a new vision and a fresh infusion of capital. This was the expectation: a clean break from the past, a new chapter. Then came Friday. The steep, unforgiving drop wasn't a profit-taking session, it was a brutal repricing. The high volume, over 472 million shares traded, suggests not just retail exuberance, but a significant amount of institutional repositioning, or perhaps a well-timed bearish attack that took advantage of the inflated sentiment. While many were celebrating the rally, the smart money was quietly assessing the fundamentals, and Friday's price action seems to indicate a very cold reality check. The market is suggesting that while the leadership change is a positive development, it doesn't instantly solve the deep-seated business model challenges Opendoor faces, especially in a volatile housing market. This tension between the turnaround story and the fundamental reality is what makes Opendoor stock so captivating and so dangerous. The recent price action for Opendoor has been nothing short of a roller coaster, demonstrating the high-risk, high-reward nature of this particular investment. The stock saw a meteoric rise, largely on sentiment and the excitement surrounding its leadership and capital structure news. This kind of explosive growth is often driven by a short squeeze, where bearish bets are forced to cover, adding fuel to the fire. However, the massive sell-off on Friday shows that this momentum is fragile. While the stock's volume on the day was astronomical, reaching levels not seen in a long time, it was overwhelmingly on the sell side, pushing the price down. It's a classic case of the emotional, narrative-driven buying meeting the cold, hard logic of technical and fundamental analysis. The daily chart now has a massive red candle, and the intraday low of $8.76 shows the sheer panic that set in. The stock now sits precariously close to key support levels. A break below them could spell further trouble, potentially unwinding a significant portion of the recent gains. The institutional activity around the stock is mixed. While some institutions have recently increased their positions, hoping to ride the turnaround, others have been using the rally as an opportunity to exit, cashing in on a stock they saw as overextended. This divergence in institutional opinion is a key signal that there is no clear consensus on Opendoor's future. The entire sector is under macroeconomic pressure. Rising interest rates and persistent inflation have been a headwind for the housing market, directly impacting Opendoor's core business model. The company makes its money by buying homes, holding them, and then reselling them at a slight premium. In a slowing market, this iBuying model becomes incredibly risky, as inventory can sit for longer and prices can depreciate, leading to significant losses. This is the fundamental headwind that the new leadership team must navigate, and it's a monumental challenge that can't be solved by a simple press release. We've seen similar dynamics in other high-growth, high-volatility names like Tesla stock and Nvidia stock, where the underlying business narrative clashes with macroeconomic realities or unexpected market shifts. This isn't just about the stock, it's about the entire market's perception of risk and reward in a new economic landscape. At its core, Opendoor Technologies, Inc. is a digital-first real estate company that operates as an iBuyer. Their business model is built on using proprietary technology to provide instant cash offers for homes, streamlining the traditional, often cumbersome process of selling a house. They buy the property directly from the seller, conduct necessary renovations, and then relist it on the open market. This model, while innovative, is capital-intensive and highly sensitive to market fluctuations. In a hot housing market, it's a home run, with homes appreciating quickly and flipping for a tidy profit. In a cooling or declining market, it becomes a liability, as the company holds a massive depreciating inventory. The company has a long history of impressive revenue growth, particularly during the pandemic-era housing boom. But it has also been plagued by persistent unprofitability and a string of significant net losses. This has always been the central tension for Opendoor. Can they scale their business to a point where the iBuying model becomes consistently profitable, or will it remain a feast or famine enterprise tied to the unpredictable cycles of the housing market? Previous reports have shown that Opendoor's cost of revenue has often outpaced its revenue growth, squeezing its margins and leading to quarterly losses. The recent leadership change, however, signals a renewed focus on profitability and operational efficiency, aiming to de-risk the model. The new CEO's background at Shopify, a company known for its scalable platform and focus on empowering merchants, suggests a strategic shift towards building a more robust and less capital-intensive real estate platform. This could mean a move away from pure iBuying to a more diversified suite of services, like brokerage and financing, which could provide more stable, recurring revenue streams. This kind of strategic pivot is not unheard of in the tech world. For example, the evolution of many of the investing sites we see today, from niche platforms to diversified financial powerhouses like Fidelity, Robinhood, and SoFi. Looking ahead, the future of Opendoor stock is a fascinating case study in market psychology and fundamental reality. The market is now waiting to see if the new leadership can translate its vision into tangible results. The key catalysts to watch will be the upcoming quarterly earnings reports. We will be looking for signs of a turnaround in profitability, even if it comes at the expense of top-line revenue growth. The market might be more forgiving of a slowdown in sales if it means a clear path to positive net income and a more sustainable business model. The recent $40 million private stock sale to Khosla Ventures and Eric Wu is a significant vote of confidence, but it is a relatively small sum in the grand scheme of things for a company with a multi-billion-dollar market cap. It shows commitment from key players, but it doesn't solve the long-term capital needs. The risks are substantial. A prolonged downturn in the housing market, continued high interest rates, and the risk of a recession could severely cripple the iBuying model. The competitive landscape is also a factor, with other players like OfferPad and even traditional real estate firms adapting to the digital age. For anyone engaged in online investment, this is a prime example of why you must look beyond the headline-grabbing news and dig into the company's financials. Using tools from services like Schwab Intelligent Portfolios or a self-investing platform can help you analyze the numbers, but it requires a human eye to see the bigger picture. The bullish narrative is that the new leadership will pivot the company using its tech-first approach to create a more resilient and profitable business model. The reality, however, is that this pivot will take time, and the core iBuying model remains exposed to significant macroeconomic risk. The dramatic sell-off on Friday shows that the market is not yet convinced that the turnaround is a foregone conclusion. This is the reality check that was bound to happen after the massive sentiment-driven rally. It's a good reminder that every investment, from Tesla stock to Opendoor, involves a careful balance of expectation and reality. It's a journey, not a sprint. We are going to have to see how the new management team addresses the issues head-on and if their strategic vision can truly rewrite the rules of real estate. How many shares of Opendoor Technologies do you currently hold? Comment below and let us know your thoughts on the recent leadership changes and the stock's future. The journey of Opendoor stock from a speculative play to a potentially mature, profitable business is far from over, and the path is likely to be filled with more volatility. The initial hype has now been replaced by a more sober and cautious outlook, and only time will tell if the new leadership can bridge the gap between market expectations and operational reality.